By most industry estimates, the global silver market has remained in supply deficit for several consecutive years. In simple terms, the world has been consuming more silver than it produces. Under normal circumstances, this might be expected to place upward pressure on prices, but that didn't fully happen. Silver prices did rise, but only gradually, almost quietly. So this raises an important question. If supply has been insufficient for years, why hasn't silver already moved significantly higher? To explore this question, we need to look beyond industrial demand. While supply and demand remain important, broader credit conditions have historically played a significant role in shaping silver prices. To understand what may be happening today, we need to step back several decades. Since the early 1980s, silver has undergone a long transformation. During this period, global financial systems increasingly shifted toward fiat currencies, particularly the US dollar. As confidence in sovereign paper currencies expanded, silver gradually lost much of its monetary role. It stopped being viewed primarily as money. Instead, it became categorized mainly as an industrial metal. When an asset loses its monetary identity, markets begin pricing it differently. Its value becomes linked to manufacturing cycles, fabrication demand, and industrial consumption. In other words, it becomes just another commodity. This transition helps explain why silver prices remained relatively subdued for decades, despite periodic shortages or rising industrial usage. But economic cycles do not move in only one direction. Today, the broader credit environment appears to be changing. U.S. government debt levels have continued to rise relative to historical benchmarks. At the same time, Treasury yields have entered an upward phase, increasing borrowing costs across the global system. When debt expands faster than economic capacity, confidence in currency stability can begin to tighten. And this is where silver re-enters the discussion. Both fiat currencies and precious metals can function in different ways as stores of purchasing power. When confidence in paper currency expands, monetary metals tend to lose relevance. But when confidence in financial systems contracts, monetary metals may gradually regain importance, not suddenly, but progressively. However, the most overlooked factor may not be demand, it is inventory. During the decades when silver evolved into a primarily industrial commodity, something important happened in the background. Financial inventories of silver declined significantly. Industrial supply continued. Silver was mined, consumed, and recycled. But the silver held specifically for financial or monetary purposes steadily diminished. In some cases, available reserves approached historically low levels, and this distinction matters because when an asset regains monetary relevance, markets may begin rebuilding inventories. And rebuilding inventory requires physical metal, not contracts, not derivatives, physical ownership. In environments characterized by a strong currency confidence, financial instruments are usually preferred. Investors favor bonds, cash equivalents, or derivatives because they offer yield and liquidity. Under those conditions, there is little incentive to demand physical silver. But when confidence dynamics begin shifting, behavior changes. Participants increasingly prefer ownership rather than exposure. Paper claims may gradually give way to physical settlement. What appears as rising commodity demand may actually reflect something deeper, a rebuilding of monetary inventory. And this process can become a meaningful influence on price dynamics. Around the middle of last year, silver prices began accelerating. From a traditional commodity perspective, this move may seem difficult to explain. Industrial demand did not suddenly surge. Mining output did not collapse. Instead, what may have shifted was the underlying credit environment influencing asset preference. Markets may have started transitioning from viewing silver purely as an industrial input toward recognizing it again as a financial reserve asset. If that interpretation holds, price movement becomes a symptom, not the cause. This distinction is essential. Commodity cycles are typically short-term. Credit cycles, by contrast, often unfold over many years. If silver is entering a phase where its monetary characteristics regain relevance, the adjustment process would likely be gradual. Financial inventories cannot be rebuilt overnight. They require sustained accumulation over extended periods, which means recent price behavior may reflect a longer structural transition rather than temporary speculation. So the key question is no longer simply whether silver demand exceeds supply. The deeper question is this: is the global financial system beginning to reassess what constitutes a reliable store of value? If so, silver's recent behavior may represent an early stage of a broader shift, one driven not primarily by industry but by credit conditions. And today, early real-world signals are beginning to emerge that may support this framework. In the next episode, we'll examine two developments currently unfolding in global markets that appear to validate this transition. If this framework proves accurate, recent price behavior may represent the early phase of a broader market reassessment rather than a short-term commodity cycle.